Hello and welcome back to the Dividend Hub and the portfolio update for August. So we're gonna jump right into this because I've been feeling a bit sick. So let's blast through this thing. So the dividend income of the month has been really good. This is has been about 25% higher than our average monthly dividend, which is like $6, $6.50 maybe, something like that at the moment. So we got 99 cents from Realty Income, $1.41 from AbbVie, $1.04 from Hormel Foods, 98 cents from Starbucks, $1.05 from Lowe's, 56 cents from A.O. Smith, and then we got $2.33 special dividend from Canadian Natural Resources, which is also one of the stocks I bought this month. Actually, completely unaware that they had a special dividend this month that we just happened to hit. But that's fine. Gonna accept the almost $2.50 happily and move on. So, interesting news this month is that Altria did increase their dividend by about 4%. So from 90 cents quarterly to 94 cents quarterly, or $3.60 annually to $3.76 annually. This for us is about a 0.81% income gain for the portfolio. So that was really nice. Let's go into the buys of the month then. So the first one is going to be Canadian Natural Resources. Obviously, I bought this mainly for two reasons. The dividend growth rate of this stock is really, really good. Over 10 years, their average is 18% or 18.08% to be very specific. They are a long-term dividend payer, and they've been consecutively paying dividends for 20 years or 21 years, somewhere around there, with a very low payout ratio. Right now, it's about 25%. And obviously, the oil as a natural resource has had some significant growth, and so has this company. So there are a few things that I don't like about this company. First of all, its oil exposure, which I'm not a huge fan of, but I also see it as, if we're going to diversify this portfolio, then oil should probably be at least a small part, and that's fine. Their consecutive dividend growth has only been about 6 or 7 years, which is a little bit low for my taste. But this is a little bit of a gamble, and it's going to be, over the long term, this is going to be a very small part of the portfolio. So that's completely fine. They do have a lot of debt, which is not amazing either. So there are some pros and there are some cons. Again, going back to that, I bought this mainly because they have extremely good dividend growth rate, and that it's some exposure to something that we don't have exposure to today. So we bought 2 shares for $54.02 each, totaling $108.04. And here we can see that the short-term dividend growth of this stock has been absolutely amazing. Their last dividend increase was almost 43%, and the 3 and 5 year both are over 20%. So if they can even keep up like 10 to 15% for the coming few years, this is gonna be mega worth it, right? At least that's what I feel like. So moving on. The second one is going to be Coca-Cola. Obviously, this is kind of the opposite, right? This is something I bought because they are a very very long-term dividend growth stock, and they've been growing their dividend for 59 years consecutively. It's also an extremely stable company that's unlikely to go away for a long while, right? Everyone knows what Coca-Cola is. I already have Pepsi in the portfolio, so getting this feels like, uh, two puzzle pieces together kind of deal. Few things I dislike about this stock, just generally, it feels pretty expensive. Their payout ratio is above 70%, which is not amazing, but it's not that bad. Their dividend growth is a little bit on the low side. It's 5.61% on average over the last 10 years. It's fine. This is a buy that increases the stability of the portfolio. At least that's how I felt. Bought two stocks or two shares at $64.83. With a total of $129.66. If we look back here, it's a little bit over the $200 this month, but we've been going under a bit the other months. So at the end of the year, the aim is to hit that $200 a month average, right? That's going to be fine. So short term, this growth, the dividend growth for this company has been a little bit lower, 3.5% 5 years, 3.23% 3 years, and almost 5% last increase. It's fine. Stability is the goal there. So this is the current status of the portfolio. Obviously, as we can see in the top right there, the dividend for this month has been quite significantly higher than the other months, and we are the portfolio has lost about 1.5% so far. Nothing weird or anything. We're about to break $80 annually in dividends, which is going to be really nice. I feel good about that. Moving into the overview here, T Row is definitely the T Row and Oracle are the two biggest losers in quotation marks that we have in the portfolio, and Intel is pretty close behind. So for the next month, I've been considering a bit. So if you look on the allocation of the portfolio right now, we're starting to even out a little bit compared to how it was in the beginning. And I think we're going to try and keep around 2%. So stocks that dip under that 2% mark, I probably want to increase. So Intel is the one that's in that area now. The only problem with Intel and my reluctancy to kind of just get another one right now is I'm trying this year to focus a little bit more on dividend growth, and our 10-year average growth rate over the portfolio is about 11.4%. Intel doesn't, it's dragging down the average, right? So I'd rather, for the last few purchases of the year, focus on things that will pull that average up. We're not going to hit the 15% that I had as a goal for this year. And that's probably a good thing. The more I've been dabbling with these things, the less I think that's actually a realistic goal. I think if you are between 10 and 15%, you're in a good growth space. That's at least what I feel like. But yeah. So I think that's it for this month. We have 2 more months until this portfolio is exactly a year old, which is going to be really fun. And then a couple of more months, and then we have the end of the year review to take a look at. But this is it for this month. So thanks for watching, and have a really nice day.